This is a trade setup in Russell 2000 index options. We're going to look at December 15 options expiration cycle with 60 days to go. This is a broken wing put butterfly. It's a variation of an EIP trade. EIP normally has a 50-point wing on the downside and a 30-point wing on the upside. In this case, I am using a 50-point wing on the downside and a 40-point wing on the upside. I'm going to center this butterfly about 10 points below where Russell is currently trading, right at 1490. So I'm selling 1490 puts, I am buying a 1440, and I'm buying a 1530. So we're going to go through a process of setting up this trade. So step one, we're going to choose the underlying asset, which is the Russell 2000, RUT is the ticker. Step two, we're going to pick our duration. I want to enter this trade anywhere between 56 to 60 days. So December 15 option expiration is right at 60 days away from expiration. Then we're going to select our strikes. So we're selling options that are 10 points underneath the market. So at 1490, I'm selling 2. I'm buying 1 1440, and I'm buying 1 1530. Next step is going to be a risk management plan, setting up my profit target and my stop loss for this trade. I'm going to look to make between 10 and 15% return on my risk. So for this one put butterfly, current margin is right around 1630. This trade is currently going for about $6.30 debit. So if my margin is 1630, I'm going to try to make about $160, maybe $180 per one contract. And my risk, I don't want to risk a lot more than what I'm looking to make. So my stop is going to be a loss of about $180 per one contract. Next step is how I'm going to manage this trade if this trade starts to get into trouble. As we can see, this is a non-directional income trade where this trade benefits from the passing of time. This is a pure theta play. So as we can see that this is our T+0 line over time, and as RUT trades anywhere between 1450 and about 1525 over the next month or month and a half, we're going to make money. Now this trade starts to get in trouble if we do see a big move in either direction, and we're going to talk about what the risk management plan is in case RUT does move outside of the profit tent. So I'm looking to scale into this trade. I'm probably going to use tier 2 and tier 3 on the upside. So my short strike for tier 1 is at 1490. If Russell trades above my long put on the upside, which is right at 1530, I'm going to look to add tier 2, which is going to be centered 30 points above my tier 1. So my tier 1's at 1490. I'm going to look to put my tier 2 at 1520. And I'm also going to use 50-point wing on the downside and a 40-point wing on the upside. And then if Russell continues to trade higher and it trades above my long put on the upside, that's going to trigger tier 3, and tier 3 is going to be positioned 30 points above short strike of tier 2. Now, if I don't get to scale into a tier 2 and tier 3, my risk plan is to make 10 to 15% on margin and exit this trade. So if at any given time, if I'm only in tier 1 and my position is down about $180, I'm going to look to exit. On the downside, this trade is pretty flexible. So if we're going to see RUT trade on the downside and we're trading about 30 points below our short strike at 1490, so if we get to about 1460, I can exit this trade for probably a scratch or break even. Or what I can do is I can roll my 1530 put, which is going to be at a profit, up to 1540. So what this is going to do, it's going to reduce my risk on the downside. It's going to introduce a little bit more risk on the upside. And if we continue to see Russell to trade lower under 1440, I'm probably going to look to exit this trade. And again, my stop loss is a point where my trade is down about $180 per one contract. So right now this trade is going for a debit of around $6.40 to maybe $6.60. I think it's a decent price to pay to put this trade on. I'm looking to be in this trade about 30 to maybe 45 days. So I want to be out of this trade with about 2 weeks until expiration. So I'm going to go ahead and try to enter this trade. I'm going to try, so mid price right now is 645. I'm going to start to bid at 630. If I don't get a fill, I don't know, 10-15 minutes, I'm going to slightly increase my bid to 640, then go up to 650, maybe 660. If I still don't get a fill, I don't want to chase and pay $9 for this. So if I don't get a fill at about $6.60, I may just hold off there and revisit this trade setup tomorrow.